Welcome back, guys. Today we're going to be talking about a quote from Warren Buffett where he says, "The best way to minimize risk is to think." I think this is simply put, very well said. Kirby, I'll let you open it up though.
I think this tie into the last video we did about FOMO and how, what's the canary in the coal mine is snow when it's a stock and investment or something's going on, Beanie Babies or whatever, Pokemon cards. What was the
NFTs.
picture things that they was doing, NFTs and all that other stuff. Um, just think, um, and not trying to get biblical, but the Bible said the road to destruction is wide and everybody will travel. The road to salvation is narrow and many people will ever find it. That right there could be parsed a lot of ways. A lot of ways. And I look at it just like this. If everybody's going in the direction, I don't believe everybody's smart. So I'm not going in that direction. I'm trying to find an off ramp as fast as possible. But just think, like another one that you pointed out in the last video was don't spread your eggs too thin. Don't spread your money too thin. Everybody, and even we talked about it in the class. You wasn't there last night, but somebody said Warren Buffett believes in diversification. I said, where do you get that from? I said, Warren Buffett only invested in one stock his whole life, personally. One stock in his whole life. That's it. And then it's a famous, Berkshire Hathaway conference call. They do the annual meeting. And Warren Buffett said, diversification is good if you want to be a C student. You'll still pass, but you won't reach alpha with being diversified. For the life of me, I always hear people say it, and you can see CNBC, you can see, the social media influencers on finance. They always talk about, oh, diversification, diversification. Anybody who has money, they did not get there by diversifying. They got there on a singular endeavor, either real estate, either stocks, either business, or it's one singular thing that got them there. They diversify to keep the money, not to make it. That's a big misconception. Diversification is something that these financial brokers, financial gurus, these financial advisors came up with to just suck money out of you. But there is a caveat to that. If you don't understand fundamentals of a company or investment, no matter if it's real estate, business, whatever, if you don't understand the fundamentals of how this thing works, then you need to diversify. But the people that's making the money, they are savages when it's coming to gaining knowledge and understand how the fundamentals work. And then they put their capital, all of their capital, into the endeavor after they understand exactly how one apparatus works. And then they ride with that. They're not sitting here buying a plethora of crap and just hoping, throwing stuff against the wall and hoping one of them takes off and go 500x. That's not how the game is going. I mean, even with Berkshire Hathaway, Warren Buffett invested in Berkshire Hathaway. Berkshire Hathaway, their first 5, 10 investments, they just bought insurance companies. It's all insurance. And then when they start buying financials, they only could buy 10% of the company. If they could buy more without, considering themselves a bank, then they would do it. But look at their portfolio. It's the American Express, it's the Bank of America's, it used to be the JP Morgans and things of that nature. But also insurance. Insurance. They're fundamentally focused on companies that they know, and then they back the truck up and put a lot of money into them. If not, just buy them outright if they can. That's the name of the game. All this diversify, have a portfolio of 50 stocks. That means you ain't thinking, you just listen to somebody on YouTube say, hey, buy this stock, buy this stock. So now you got 50 stocks, you got $10,000, 50 stocks. If one of those stocks go up 200%, you made what, $300? Now, if you had $10,000 in that one stock because you did fundamental analysis on it and you knew it, then it went up 300%. Now you're at 30,000 because you spread it all across this and you got $10 here, $20 here, $30 there. You have no money in the game and you sitting there looking foolish because lack of thinking. When you understand the fundamentals and understand what a company's doing, that's your biggest road to safety. So when the stock goes down, you're not panicking. When you don't know what the hell you're doing, you see a stock go down. Oh, let me sell it before I lose all the money. Stock price has nothing to do with the company. The market can be rational longer than you can be solvent. So I always tell people, I spend more time before I invest in a stock than I do in real estate. I mean, I do spend time on real estate, but I'm just saying the timeline that I spend to invest in the stock, I will spend longer time on that than real estate. And it's two reasons why. Well, I'll just give you one. With the stock, I am 100, excuse me, I am 100% dependent on somebody else running the company. I have no input or anything in how that person runs a company or how the board runs a company. With real estate, I got to depend on me, and you can bet your ass I'm gonna work overtime to make sure it's work right. So I have some input. I can operate, but the thing is, I understand the fundamentals of how that side of the business work also. So this whole diversification, spread your money out all the ways to just hope and pray something hits. That's why it's so risky. That's why the stock market is so risky because people just following blindly and don't understand the fundamentals of how companies work. Alex, what you got?
Yeah, this is a very good quote, and I like it especially because it goes hand in hand with something Robert Kiyosaki said, which is if it's something you understand, and I'm probably not quoting it word for word, but if it's something you understand, then how is it of any risk to you? So if you understand what you're investing in, there is no risk. You understand it. And when I hear people especially talk about, diversification because you want to manage your risk, then you don't know what you're investing in. You simply don't. You don't know what you're investing in. You haven't studied it. You haven't researched it. You probably don't even understand the market that it's in. So if you fully understand what you're investing in, then there is no risk to you. And in that point, and only in that point, can you put in, you know, as much money as, we're talking about, where you go full in on that one stock or two stocks. But to just spread your money thin, yeah, it doesn't make any sense. Um, and I mean, the same thing goes for like real estate. Like, if you know the area, if you know the market, if you know what you have to do all those checks and you have to do all that research before buying a property. You have to know where you're investing, what jobs are in the area, um, what is the household income, the rent in that area, how is the neighborhood at night, how is it in the day? Like you know all these things. So if you did all your thinking, then there is no risk to you. But if you didn't think, if you just said, "Oh, look, a house on Zillow, it looks nice on the inside, let me buy it." Now you're putting yourself in a risky situation. So it's the same thing with
Mhm.
stocks. If you don't know anything about the stock that you're investing in, like GameStop, and you just think that, oh, it's just going to the moon because people are buying it and I see the stock price climbing, but you don't know anything about the company's financials, then don't be surprised when it comes back down. I mean, that is all it is.
I.e., the company is losing money every quarter. The company does not produce a profit. The company is diluting its shareholders every time the stock price go up when the meme praise go on to make your shares worth less. All of those things are fundamentally things that you should know. But just because somebody go on the internet and post it, everybody be like, oh, I don't have no knowledge. Let me just follow him. And don't realize they just gaming you. It's called a pump and dump. They gaming you to go buy it to pump it up so they can exit, and then you're sitting there holding the bag.
Exactly. Exactly. With all that being said, though, guys, if you have any questions or comments, let us know down below. Don't forget to like the video, share, subscribe. We'll see you guys in the next one.